You know, every single day we put our trust and our money into banks. But behind that friendly face at the counter or that slick mobile app, there's this hidden world of data humming along, constantly watching every single move. This is the story of the secret scorecard that really decides if your bank is safe, and it's a system that's built on a long, fascinating history of financial databases.
I mean, it's the most basic question, right? You put your paycheck in, you hope for the best. But what's the actual measure of a bank's health? Is it the size of the building? The flashy commercials they run? The answer, as you might guess, is a lot more complex and a whole lot more secret.
See, the financial watchdogs, the regulators, they don't leave this to chance. They use this incredibly detailed and totally confidential rating system. It's a scorecard that gives them a raw, unfiltered look inside a bank's real operations. And it has this really unique name.
This system is called the CAMELS rating. And honestly, it's the absolute gold standard for bank supervision. It's the secret scorecard that's behind pretty much every major decision regulators make.
The best way to think about it is like a bank's final report card. But it's not just one grade. It's a really deep dive into 6 crucial areas that, when you put them all together, paint a complete picture of a bank's health, and, just as importantly, the risks it's taking.
The scoring system itself is actually pretty simple. Each of those 6 parts gets a rating, from 1 to 5. Now, a 1 is basically an A+. It means the bank is solid, well-run, no problems. But a 5? Oof. A 5 is a huge red flag. It means the bank is in serious trouble, with issues that could threaten its very survival. The stakes here are incredibly high. Okay, so what in the world do these letters even stand for? CAMELS. Well, each one represents a pillar that holds up the entire bank. So let's break it down one by one. First up, C is for capital adequacy. That's the bank's financial cushion. Does it have enough cash on hand to take a big, unexpected hit? A is for asset quality. You know, a bank's main assets are its loans. So if it's holding a bunch of bad loans that are never going to get paid back, that A score is going to tank. M is for management. Simple enough. Are the people in charge making smart decisions, or are they steering the ship right towards danger? E is for earnings. Is the bank actually making money consistently? L is for liquidity. This is a big one. If everyone panicked and wanted their cash tomorrow, could the bank actually pay up? And finally, S is for sensitivity. How would the bank handle a sudden shock, like interest rates going through the roof or a market crash? So, a rating this important doesn't just come from a gut feeling. It's the end result of this massive data operation, built on a whole history of financial databases that have been getting more and more sophisticated over the years. They track every loan, every trade, every possible risk. So where's all this data coming from? Well, for every single letter in CAMELS, regulators are tapping into these specialized data streams. They're looking at capital ratios for the C, digging into loan performance for the A, and following audit trails for the M. And these systems weren't built overnight. They represent decades of learning how to better track and measure financial risk. It's not just a snapshot. It's more like a full-length movie of the bank's financial life.
But here's where it gets really interesting. Because if it was just about plugging numbers into a computer, you could just have an AI do it, right? But that is not the whole story. Not even close. The final score is this amazing blend of cold, hard data and, well, human judgment. The databases give you all the facts, the ratios, the trends, the metrics. But it's the actual examiners on the ground who provide the context. They're the ones doing interviews, testing the bank's controls, and just getting a feel for the culture of the place. So the CAMELS score is really where data science meets real-world experience.
Now, this system wasn't just invented yesterday. Its history is actually a pretty cool story about how financial regulation has had to constantly play catch-up with a world that's always changing.
So, the original system, just CAMEL without the S, was rolled out way back in 1979. But it wasn't set in stone. After the 2008 financial crisis, regulators had this huge aha moment. They realized that banks that looked perfectly healthy on paper were getting completely wiped out by market shocks. So they added the S for sensitivity to market risk, turning CAMEL into CAMELS. It was a painful but really crucial lesson that proved this system has to be able to evolve to face new kinds of threats.
And its influence is massive. I mean, all the major U.S. banking regulators, the OCC, the FDIC, the Federal Reserve, they all use this framework as their guide. And a bad score isn't just a slap on the wrist. It can trigger serious enforcement actions, put a bank on a watch list, and basically decide how regulators would step in and dismantle the bank if it were about to fail. Here's the kicker.
You and I will never, ever see our bank's CAMELS rating. It's one of the most tightly guarded secrets in the entire financial industry. But its power is just undeniable. Behind that one single number is an entire universe of data, a massive database designed to find every single potential crack before it can bring the whole building down.
So when you step back, this secret scorecard is a true cornerstone of our financial system, and it's built on decades of data collection and analysis. It's a silent guardian, really, and it kind of makes you wonder, doesn't it? When you think about things like our credit scores or how insurance companies set our rates, what other powerful, invisible databases of risk are out there, quietly shaping the opportunities and challenges in our own lives?